Hi, I'm James Nelson, partner at Massey & Ackle Realty Services, and I'm here to bring you the September Nelson Reports podcast. In this session, I'm going to be talking about the 10 driving forces in the New York City investment sales market. One is a flight to hard quality assets. The uncertainty in Europe and in the stock market has led to investors seeking hard assets. Real estate is the only hard asset that actually cash flows, which makes it all the more attractive. Number two, New York City's residential and commercial fundamentals are incredibly strong. Right now, rents are approaching all-time highs once again, with residential rents over $100 a foot and commercial office rents approaching the same. We also see vacancy rates at all-time lows. In some cases in the Village, residential vacancy is below 1%. The big reason for this was New York City was not overbuilt in the last cycle. For example, in 2009, only one speculative office building was built. 3, a sharp supply and demand imbalance. In 2007, Massey & Ackle's inventory was around 750 exclusive listings. Today, that number only hovers around 500, which was the same in 2009. Although it took a lot longer to sell properties in 2009, today properties come to market and can sell in only a matter of weeks. It's been very difficult to keep up with the inventory. Number 4, demand drivers appear to be at all-time highs. We're seeing a lot of institutional investors re-enter the market. We also have high net worth individuals and foreign investors coming to the market, which is creating this competition. Number 5 is record low interest rates. Interest rates are now at 40-year lows. In some cases for multifamilies, you can obtain financing at under 3% for 5-year money. The number 6 driver is capital gains tax. With the sunset of the Bush tax cuts, we will see capital gains increase from 15 to 20% potentially. When you tack on the National Health Care Program, it could add another 3.8%. Number 7 is massive debt looming. This is one of the potential roadblocks in the future. With rates being kept low, that has definitely kept pricing high. However, if interest rates do spike, that could create a second wave of distress, as some of the properties that are underwater will not be able to support their debt service. Number 8, this does suggest that there may be a low interest rate bubble, so we'll have to certainly watch what happens here. Number 9, another challenge moving forward is increased operating expenses. Unfortunately, New York City right now has some of the highest property taxes in the U.S. For a new residential building, real estate taxes can be as high as $25 a square foot. When you combine that with other operating expenses, they can sometimes combine to almost 30 or 40% of the total revenue of property. So finally, the 10th driver is that at this point, value-add properties seem to be a great opportunity, as there's a big disconnect between vacant properties and those that are fully rented out, as core assets with triple net tenants can pay big premiums. So that's it for this month, and look forward to being in touch. Thank you.